5 most important types of liquidity in 40 seconds. 1. Equal highs. This is where price hits the same highs more than once, creating a stronger draw than a single high. 2. Liquidity pools. These are areas with multiple highs of trapped liquidity and can be stronger than equal highs. 3. Internal liquidity. These are areas inside a trend that when swept can be a valid entry for a continuation. 4. Swing highs. These are single highs and when swept can create powerful moves. 5. Liquidity engineering. This is the market trapping early buyers while leaving liquidity above, preparing for a big move to sweep all the highs. From this chart, do you think price is more likely to take out buy-side liquidity or sell-side liquidity? You have 5 seconds to decide. All right, time's up. Now let's analyze it step by step. First, the thing that stands out is a liquidity sweep that impulsively broke structure to the upside, leaving a fair value gap at the discount of this range. So one plan would be to take our trade from that fair value gap, stop loss just below the swing low, and target the buy-side liquidity. If you chose buy-side, you would have been wrong, despite all those confluences lining up. Now for those who said sell-side, you were correct. Here's why. Price also broke several structures to the downside, leaving behind fair value gaps. Right now, price is sitting at a fair value gap in a breaker block, and it just rejected from that area. So our play is to take the entry from there, stop loss just above the fair value gap, and target the sell-side liquidity. And as you can see, take profit got hit. This doesn't mean the person who said sell-side is a better trader than the one who said buy-side. Sometimes, no matter how good your confluence or your strategy is, you will still lose. Follow for more.
This is one of the most common mistakes traders make. You see the breakout, clean, clear, textbook. Everyone's waiting for that retest to come in. So far, everything looks perfect until it doesn't. Here's where the mistake happens. Traders zoom in for confirmation, while the entire structure has already changed behind the scenes. Look closer at the low area. Price bounced, it reacted, and quietly built a new lower high before the original retest even formed. On the surface, it looks like the same setup. But in reality, we now have 2 overlapping structures inside the same range. And that changes everything. Because what you thought was a bearish continuation is now turning into a bullish break and retest setup. The lesson? Don't get trapped inside a single perspective. Always check if structure actually stayed the same.
An order block is a single or series of up-close candles into an important level before price displaces and closes below the opening price of that single or series of up-close candles, validating it as an order block. Then when retested, I'm looking for price to trade away from that order block. Similarly, with a bullish order block, we have a series or single down-close candle into an important level, which then gets displaced and closed over, validating it as an order block. Then when price retests this area, I want to see it trade away. A propulsion block is an order block off of another order block. So for this example here, we have a down close candle into an important level, which is then closed over, validating it as an order block. Then price retraces and reaches into this order block, then closing over this down close or series of down close candles into this order block. That then creates a propulsion block. Now, with a propulsion block, I anticipate the opening price to be very sensitive. I do not want to see price break the mean threshold of a propulsion block.
Liquidity sweep. Change of character. Point of interest. Order block. Sell side liquidity. We enter from the order block and target the sell side liquidity.